Welcome to a new IFRS Educational Fund series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards, IFRS, through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions of set 1 to which the answers have been provided on IFRS 9. This is the standard on financial instruments. Viewers and subscribers have 30 seconds to select or choose the answer to each question. The answers to the 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 1. For the relevant financial instruments, IFRS 9 does not deal with which of the following? A. Recognition. B. Reclassification. C. Measurement. D. Disclosure. E. Hedge accounting. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 2. IFRS 9 does not deal with which of the following? A. Financial assets. B. Financial liability. C. Transfer of assets. D. Equity instruments issued by an entity. E. Interest in a subsidiary measured at fair value. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 3. For which of the following does IFRS 9 not apply where the item is not to be received or delivered? A. Contract to buy or sell a non-financial item that can be settled in cash. B. Contract to buy or sell a non-financial item that can be settled in another financial instrument other than cash. C. Contract to buy or sell a non-financial item that can be settled by exchanging financial instruments. D. Contract to buy or sell a non-financial item that is irrevocably designated as measured at fair value through profit or loss. E. None of the above. Some counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 4. Financial assets arising from a regular way purchase are recognized on the dash. A. Authorization date. B. Legal date. C. Trade date. D. Settlement date. E. C or D. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 5. IFRS 9 applies to which of the following? A. Investment in a subsidiary accounted for at fair value. B. Investment in a subsidiary accounted for at cost. C. Investment in an associate that is equity method accounted. D. Investment in a joint venture that is equity method accounted. E. All of the above. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 6. Which of the following is not a subsequent classification of financial assets? A. Financial assets measured at cost. B. Financial assets measured at amortized cost. C. Financial assets measured at fair value through profit or loss. D. Financial assets measured at fair value through other comprehensive income. E. None of the above. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 7. Reclassification adjustment can arise with respect to financial assets previously classified as dash. A. Fair value through profit or loss. B. Fair value through other comprehensive income. C. Amortized cost. D. Cost. E. Derivative. Time counts. 10 seconds gone. 20 seconds gone. 'Timer. Question number 8. A gain and loss on a financial asset or a financial liability that is measured as fair value may be recognized in other comprehensive income when it is dash. A. Part of a hedging relationship. B. An equity instrument investment that an entity has elected to present gains and losses thereon in other comprehensive income. C. A financial liability designated as fair value through profit or loss, and an entity is required to present the effects of changes in liabilities credit risk otherwise. D. A financial asset measured at fair value through other comprehensive income, and an entity is required to recognize some changes in fair value therein. E. All of the above. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 9. A pair out of the following exists in hedge accounting. A. Hedge instrument and hedge item. B. Hedge instrument and hedging item. C. Hedging instrument and hedged item. D. Hedging instrument and hedging item. E. Hedge instrument and hedge item. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 10. Loss allowance for expected credit losses is not recognized on which of the following? A. Financial assets measured at fair value through profit or loss. B. Financial assets measured at fair value through other comprehensive income. C. Financial assets measured at amortized cost. D. Issued financial guarantee contracts. E. Issued loan commitments. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. We proceed to review the answers. Question number 1. The answer to question number 1 is D. Disclosures. IFRS 9 does not deal with disclosures on financial instruments. It deals with the recognition, measurement, classification, reclassification, impairment, and hedge accounting of financial instruments, excluding equity instruments from perspective of the issuer. However, financial liabilities do not come under impairment consideration. It is IFRS 7 financial instruments disclosure that deals with disclosures on financial instruments. D is the answer to question number 1. Question number 2. The answer to question number 2 is D, equity instruments issued by an entity. IFRS 9 deals with financial assets, financial liabilities, transfer of assets, and interest in a subsidiary measured at fair value in line with IFRS 9. It does not deal with equity instruments issued by an entity. Financial instruments issued by an entity that meet the definition of equity instruments are within the scope of IS 32 financial instruments presentation. It is only from perspective of the holder of such equity instruments, that is, investment in equity instruments, that IFRS 9 applies. D is the answer to question number 2. Question number 3. The answer to question number 3 is E, none of the above. IFRS 9 applies to those contracts to buy or sell a non-financial item that can be settled net in cash or another financial instrument, or by exchanging financial instruments, as if the contracts were financial instruments, with the exception of contracts that were entered into and continue to be held for the purpose of the receipt or delivery of a non-financial item in accordance with the entity's expected purchase, sales, or usage requirements. Even when the contract is entered into for the purpose of receipt or delivery of a non-financial asset in accordance with the entity's expected purchase, sale, or usage requirements, IFRS now applies to the contract if it is irrevocably designated to measure at fair value through profit or loss. E is the answer to question number 3. Question number 4. The answer to question number 4 is E, C, or D. A regular way purchase of financial assets requires that the assets are recognized on either the trade date or the settlement date. The trade date is the date that an entity commits itself to purchase or sell an asset. The settlement date is the date that an asset is delivered to or by an entity. A regular way purchase or sale of a financial asset is a contract whose terms require delivery of the asset within the time frame established generally by regulation or convention in the marketplace concerned, e.g. on a stock exchange or a commodity exchange. E is the answer to question number 4. Question number 5. The answer to question number 5 is A, investment in a subsidiary accounted for at fair value. IFRS 9 applies in some cases to interest in a subsidiary, associate, or joint venture where such interest is accounted for at fair value in line with IFRS 9. Where investments are accounted for at cost, or using the equity method for interest in subsidiaries, associates, and joint ventures in accordance with IFRS 10 consolidated financial statements, IAS 27 separate financial statements, and IAS 28 investment in associate and joint ventures, IFRS 9 does not apply. A is the answer to question number 5. Question number 6. The answer to question number 6 is A, financial assets measured at cost. In line with the provisions of IFRS 9, financial assets are classified as subsequently measured at amortized cost, fair value through profit or loss, or fair value through other comprehensive income. In subsequent reclassification, no financial assets are measured at cost. Rather, for the determination of their fair value, the valuation techniques provided in IFRS 13 fair value measurements are applied as appropriate. A is the answer to question number 6. Question number 7. The answer to question number 7 is B, fair value through other comprehensive income. If an entity reclassifies a financial asset out of the fair value through other comprehensive income measurement category into fair value through profit or loss measurement category, the cumulative gain or loss previously recognized in other comprehensive income is reclassified from equity to profit or loss as a reclassification adjustment at the reclassification date. B is the answer to question number 7. Question number 8. The answer to question number 8 is E, all of the above. A gain or loss in a financial asset or a financial liability that is measured at fair value may be recognized in other comprehensive income when 1. It is part of a hedging relationship. 2. It's an investment in an equity instrument and an entity elects to present gains and losses on that investment in other comprehensive income. 3. It is a financial liability designated at fair value through profit or loss, and the entity is required to present the effects of the changes in the liabilities credit risk in other comprehensive income. Or 4. It is a financial asset measured at fair value through other comprehensive income, and an entity is required to recognize some changes in fair value in other comprehensive income. E is the answer to question number 8. Question number 9. The answer to question number 9 is C, hedging instrument and hedged item. The pair that exist in hedge accounting are hedging instrument and hedge item, in line with Chapter 6 provisions of IFRS 9. C is the answer to question number 9. Question number 10. The answer to question number 10 is A, financial assets measured at fair value through profit or loss. Loss allowance expected credit losses is recognized for financial assets measured at amortized cost, financial assets measured at fair value through other comprehensive income, issued financial guarantee contracts, issued loan commitments, but not financial assets measured at fair value through profit or loss. By measuring financial assets at fair value through profit or loss, impairment losses on the assets are recognized real time in profit or loss, which makes loss allowance for expected credit losses not applicable. A is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IFRS 9 financial instruments. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the series are reserved for OJ Inspiration Limited. Thank you once again and bye for now.